My fellow stock market jobber. That's an old term. That's what they used to call traders on the British Stock Exchange. They were the market makers back then. And then, when the United States was founded, it was used as a derogatory term by the farming community for the most part. The Jeffersonians, the people in the South, used it to insult the Hamiltonians, the people that wanted to have that wanted to have banks and banking. All right, the farmers didn't really understand it because it was kind of a new concept. But anyway, here's Stock Market Jobber. We love history. But let me get into a way that we can look for trades. Now, as you probably know, I spent over 2 decades in the institutional trading world. And one of the things we do when we want to come up with trading ideas is, we don't just pull them out of the ether. We look at the market and we let the market tell us what to do. So one of the things that we can do is look at the S&P 500, which we're not going to do right now, but the S&P 500 consists of 11 sectors. Now, one of them, so we can look through the 11 sectors. Today, we're going to look at the industrial sector. Now, one of the things you need to understand about markets is that some price levels are more important than others. This is just how it is. Sometimes we know why, sometimes we don't. But here's the thing, when we get to an important level, we tend to make a tradable move. Either it breaks and continues whatever trend, or we get a reversal. So as you can see, the industrial sector here is getting close to an important level. 97 was support going back to December. Again, here in January, here in March. When a market's going lower, there's not enough demand or buy orders to take in all of the supply or sell orders. So the sellers are forced to offer out their shares at a discount in order to attract buyers off of the sidelines. And this forces a downtrend. When we get to what we call a support level, like around 97, actually it's 97.50. I have 97 here, but it's only 50 cents within a $97 stock. So, or actually ETF. So that's, we're right there. So when we get to a support level, there's a large concentration of investors who want to buy. And now notice how sometimes when we get to support, we tend to get these moves higher right off the level. Well, this is because these investors who want to buy, who are all looking to pay around 97 or 97.50, start to sense that there's other buyers in the market. How do they sense that, or why do they sense that? Well, because the price stopped going lower. So they just figure, gee, there must be other buyers around. Some of them get worried that they're going to miss buying it. They're worried that someone else is going to come along and be willing to pay a higher price. And if that's a situation, then the sellers are just going to go to them. If you're not willing to pay the highest price, you're not going to be able to buy stock because whoever is willing to pay a higher price than you is going to. So we get this snowball effect. Someone might go to 97.50. The next person says, I'm going to bid 98. The next person says 98.50. Get these bounces. When we get to support, we tend to make these moves. Now, the resistance is the opposite. When a market is going higher, it's because there's not enough supply to fill all the demand, or not enough sell orders to fill all the buy orders. So the buyers are forced to bid a premium, and this forces the uptrend. When we get to resistance, there's a lot of investors who are looking to sell at or close to that price. And these sellers, there's some of them start to sense, oh boy, there's other sellers around. How would they sense that? Well, because the prices stopped going higher. And then they get afraid they're not going to be able to execute their orders because if someone else is willing to sell at a lower price, the buyers are just going to go to them. So they start undercutting each other. One might say, I'm at 103.50. The next person might come along and say, all right, well, I'm going to sell mine at 103.40. Next person is 103.30. And it starts this snowball effect. When we look at these charts, we're looking at human psychology, right? Buyers getting anxious. That drives stuff up off support levels. Sellers getting anxious. That drives stuff down off resistance levels. If you don't look at charts through the context of what do they tell us about supply and demand and what do they tell us about human psychology, you're just not going to be successful. Now, just because we're getting close to support doesn't mean we're necessarily going to bounce. Maybe this support breaks and goes lower and the stock or the shares go lower. When I say breaks, that means if the price gets below it and holds, so you got below here for a few days, but it didn't really hold, it tells us that the investors who created the support with their buy orders have left the market. So whenever you pull a lot of buyers out of a market, regardless of what market it is, cryptos, real estate, groceries, whatever. You pull a lot of buyers out, it sets the stage for the to go lower because the sellers are not going to be able to find enough buyers and they're going to have to offer their shares out at a discount. So the point is after saying all of that over the last 5 minutes, the point is this: we're at an important level, so there's a good chance that this is either going to make a move higher or lower. I don't think there's not a very good chance that it's just going to trade sideways. Like I said, when these things get to important levels, they tend to break one way or the other. It's like a fork in the road. They don't really tend to hang out there for too long. So if you're looking for trading ideas, which is what we're doing right now, this is a good way to do it. We see a sector that looks like it's on the move of an imminent, or that looks like it's on the verge of an imminent move. Maybe it's going to be higher, maybe it's going to be lower. We just have to wait and see. We'll let the market tell us what to do. But this is what I want to talk about. What we're looking at here is an ETF that tracks the industrial sector. Spider Industrial ETF. Spider is S&P Depository Receipt. They're the firm that backs these ETFs. Like I said, there's 11 sectors, and this makes our job a lot easier. It used to be really hard to get charts of the sectors 25 years ago when I started. But now, because we have these ETFs, we can just track the ETF. Now, this is a basket of stocks. These are the stocks that are in the sector, at least the top 10. All right. I don't know how many there is, probably 30 or 40. Raytheon, UPS, Honeywell, Union Pacific, Boeing, Lockheed Martin, Caterpillar, General Electric, Deere, and ADP. It has their weightings over here. But again, we see a sector that looks like it's on the verge of making a move. So let's take a look at some of these stocks and see if anything looks appealing. All right, so first off, I see Raytheon. I don't really see too much here, but do notice again how we get to resistance and we get that sell off, right? Once again, the sellers get anxious that they're going to not be able to sell because they're afraid someone's going to be willing to sell at a lower price. So they start undercutting each other and you get this snowball effect. What do we have here? UPS. I'm not so sure I see anything here, but this is an interesting lesson here. Notice how support became resistance here, and then it became support again, and then it became resistance. Remember what I said, certain price levels are more important than others, and for whatever reason, this price here is important. I think this is probably about 195. It became support, and when the price went lower, a lot of these investors who bought it regret doing so, and they tell themselves, I made a mistake, I want to get out, but I don't want to lose money, so if it gets back to my price level, I'm going to sell. So if you have remorseful buyers placing sell orders, the level that was support returns into resistance. You can see it here very clearly. Again, you got to know where these important levels are, or you're just going to be swimming upstream, all right? And I assume you're not a salmon, so it's going to be pretty hard to do. But look at this, right? We get to support, we get the bounce, we get the bounce. Investors who bought here, a lot of them regret doing so when the price goes lower, and they tell themselves they can get out if they can get out of break even, they're going to do so. So if you have enough remorseful buyers placing sell orders at the level that was support, it turns into resistance. And we can see up here, so resistance became support. All right, remember, investors buy, they regret doing so, they try to get out of break even. Same thing happened here. We have a little bit of support here, and it turned into resistance over here. But not so sure I see really too much going on here for a trade. All right, let's go to see what our next stock is. Honeywell, not really seeing too much here, but this just shows another example of important levels. Notice this 170 level down there is clear support. This is what we call market memory. When a level that support or resistance retains its importance for a long time. And it happens a lot. If you want to be a trader, you got to forget about what they're saying on CNBC or Fox Business or whatever because 98% of the time they're wrong. Markets don't move because of fundamental news very often. The only thing that can really move a market is fundamental is things duly related to interest rates. I mean, think about it. When the Ukraine war started, for 2 weeks the market was going on or going down. It's all we heard. Oh, Ukraine, markets down in Ukraine, markets down in Ukraine, markets down in Ukraine. Well, guess what? The market started going up right after that. But the Ukraine war was not only still going on, it was getting worse. So don't listen to what they say in the media. If I was on a deserted island and I had access to my charts, but I didn't have access to the news, my analysis would really not be that different. Now, how can this help? Well, if we remember that levels that were support can stay intact for a long time, well, market's going lower and you're thinking, gee, I'd like to buy Honeywell. Where should I buy it? Oh, I'm going to buy it if it gets to 160. Well, there you're just guessing. If you let the market tell you what to do, you're going to look and see, oh, there was support at 170. There's a good chance there's going to be support again. So you would have placed your order around 170 and you would have bought it. Now you'd be looking at a profit. So it's not as good as buying it at 160, but it's better than missing it. Same is true when something is going higher. Say you bought it here and your market's moving higher and you're wondering where should I sell this? Well, look for a level that had been resistance. Former peaks. There tends to be resistance and support at former peaks and valleys. Markets don't go in straight lines, they go in peaks and valleys. So if something is trending higher or lower and it's getting close to a level that used to be support or resistance, this is a there's a good chance that that's where it reverses, all right? So in the institutional trading world, this is the type of stuff that we look at, right? We don't do like Elliott wave or Fibonacci or any of that stuff. That's like hocus pocus, Twilight Zone stuff, if you ask me. And trust me, in my 20 some odd years in the institutional trading world, I never once ever saw an institutional trader say, "Oh, look at this, Fibonacci retracement," or "Look at this Elliott wave." All right, let's keep going. All right, now this is what we would be looking for. Of course, this is a little out of date here, but when markets are oversold and they get to support, they tend to bounce. I've described what support is. It's a large group of buyers, or I should say investors, who are looking to buy close to the same price, in this case 185. Oversold is a term refers to momentum. Okay, momentum is how far something has moved from time point A to time point B. The vast majority of the time, markets are within what is their typical or usual or historical trading range. When we get below that, if we get sold really aggressively, we call that oversold. If it gets above it, if it gets bought really aggressively, we call that overbought. Now, this is important because these conditions attract sellers and buyers into the market. If we get oversold, that's going to attract momentum traders who come in and buy because they're going to be expecting a reversal to the mean or a reversal to the average. And sure enough, that's what happened here. Now, we missed this one, but this is just a learning thing, and there's always going to be other opportunities. I'll look up here. Here's a perfect example of support becomes resistance. This 240 level just happens to be important for this stock. Why? I have no idea. Why is it not 235 or 242? I don't know, but I don't need to know. I just need to know where it is. I don't need to know how electricity works, but I know if I flip the switch, the light comes on. All right. So oversold stocks that get to support tend to bounce. Remember, oversold conditions are going to draw buyers into the market who are expecting a reversion. Support is a large concentration of investors looking to pay at or close to the same price. So you got the double whammy. You got a lot of buyers around the support level, and you got the oversold conditions drawing buyers into the market. And sure enough, look at this bounce. We went from 185 to 200 in a matter of a week. And if you're an options trader, this is the type of stuff you should be looking at. Things that are overbought or oversold that get to resistance or support, because when that happens, there's a good chance the move is imminent. It's not going to go sideways like here, for example. All right, let's keep going on here. Aha, how about this? Boeing. Hmm. Well, first of all, let me point this out. Support. Let me get my laser pointer here. Support becomes resistance, becomes support. Anyway, we got to resistance. Looks like we're starting to make a move lower. It's a good chance that if we don't get above this blue line over the next few days, we can see a pretty meaningful downtrend. So you may want to keep an eye on this for a potential put trade. Where would my target be if I was to get into this? Well, I would be looking there. Former support, right? Support can stay intact. So that would be a move from about 211 to down to probably about 195. So if you're an options trader, that's a really nice move. All right. So once again, we're letting the market tell us what to do. Now let's just say it keeps going down, and in a month it gets down to here, and it's oversold. Hey, then it's time to think about buying. Remember, we're not guessing. We're letting the market tell us what to do. We're not saying, oh, if it gets to 160, buy it. It might not get there. It could get to support and then bounce. And you missed out. I've seen a lot of people miss out on a lot of profits over the years because they got too cute. They got too price sensitive. And they just guessed, right? Say you bought shares here. You say, all right, well, this was support. It became resistance. It became support. Resistance becomes support for the opposite reason that support becomes resistance. Seller's remorse. There's investors who sold who thought they did a great job when we went lower, but once it gets above their price, a lot of them regret selling and they tell themselves they're going to buy their shares back. If there's enough remorseful sellers placing buy orders, the level that was resistance turns into support. Now, say you bought it here based on this concept of resistance becoming support, and we're trending higher. And you say to yourself, I'm going to sell if it gets up to 240. Well, guess what? There was resistance around 220. So there's a good chance there's going to be resistance again around 220, and there was. So instead of guessing that the market's going to get to 240, let the market tell you, oh, there's resistance around 220. That's probably where I should have my price target. And once again, notice, right? Get to resistance, sell off, and now it looks like we're moving lower again. All right, what's next? Here we have Lockheed Martin. And now this is an interesting looking trade here. This looks like it's poised to reverse. But let me just point out once again, well, you really have a hard time with these pens here. Come on, pen. Okay, here we go. Resistance becomes support. Okay, you can see it on almost any chart. Now, this red line is a what we call a Bollinger Band. This is 2 standard deviations above the 20-day moving average. Why is this important? Well, statistics tells us that 95% of trading should be within 2 standard deviations of the mean. So if we get above it, it's overbought. It's just a different way of measuring overbought than that indicator that we looked at a few charts ago. There are different ways of measuring the same thing. So we're at a resistance level, right? 492. We see our closing price was 490. And we're above the Bollinger Band, which means we're overbought. So we're at a level where there's a group of sellers or investors who want to sell, and these overbought conditions are going to draw sellers into the market because they will be expecting a reversion to the mean. There's a lot of trading systems on Wall Street that are based on this concept of reversion. So this to me looks like a potential reversal here. So if this thing starts to head lower, I'm not saying jump in now, but if maybe we get back below, say, 489, give us a few points, that's when you jump in. And where would my target to cover be? Right down here, where this bottom was, letting the market tell me what to do. Remember, we started with a sector that looked like it's about to make an imminent move one way or the other, a tradable move. A lot of my friends joke around with me. They're like, oh, yeah, Mark, you're like, oh, it might go up, it might go down. Well, that's how markets work. You know, you wait for them to get to the important level, then you wait to see which way it's going to break or reverse. You're not going to get the exact best price if you do that, but it's going to stack the odds in your favor. No one can get the top all the time or most of the time. No one can get the bottom most of the time. There's an old saying: the only people that can sell at the top and buy at the bottom are liars. All right. So forget about trying to get the exact price. Worry about the trend, right? Institutional traders worry about levels, trends, and momentum and psychology. So, in other words, right now it's at 490, and I said, all right, well, you know what? Maybe you wait till it gets to 488 before you enter your trade, because if that happens, there's a good chance that the reversal has started. And this is probably about 475. So that's a decent move if you're an options trader. All right, now Caterpillar, this looks kind of interesting. Once again, though, let me point out I know it kind of sounds kind of obsessive, but whatever. This is what trading is. Resistance converted into support. Seller's remorse, right? People sold, price goes higher, they regret doing so, they tell themselves they want to buy their shares back. Here we have support becomes resistance. Now, we get to resistance, we made this move lower, we're around 209, we're oversold. Got a clear level down here around 200. If Caterpillar gets to 200, there's a good chance that it makes a tradable bounce. It's oversold and it's getting to a level that was support and then becomes resistance. And it's also a psychological level. People like to buy at nice round levels. So there's a trading idea for you. Put this on your radar screen. If we get to 220, maybe we look for a reversal. Now, what would be a good way to look for a reversal, right? Well, if we break the downtrend line. In other words, if the stock gets down here and then gets back above this red line, I should change the color actually. I could figure out how to do that. Anyway, we wouldn't buy it just because we got to 200. We would buy it if it starts to go back up because just because it's oversold against the support doesn't mean it can't keep going. This is an art and not a science. But if it gets to 200 and then say gets back to say 205, well, that would give me more confidence that the reversal that we're looking for is actually started. So forget about getting the low price at 200. One way of looking at it is, hey, if this thing gets to 205, I'm going to jump in because it's probably on the way back up. I'm not going to care that I didn't buy it at 200. I'm just going to care if I make money, right? I bought it at 205. It gets back up to whatever this level is up here, probably about 230, and there's your trade. You let the market tell you what to do. All right, here's General Electric. Not really seeing much here. I mean, we can see we have, clear resistance back here. Another example of market memory, right? Resistance, resistance, resistance. Ah, now this looks pretty good. This is Deere, right? Oversold. Notice we're below the lower Bollinger Band at a level that was resistance here. Levels that were resistance can turn into support. Now, what would be a potential trigger to get into this? When we trade, we have what we call a setup and a trigger. The setup is the get ready, get set. The trigger is when you actually enter the trade. The setup here is the fact that we're at a support level and we're oversold. What could be the trigger? All right, it's at 369.50. Say if it gets back above 375, then that tells us that there's a good chance the reversal has started. Listen, there's a chance that this thing could just crash and keep going lower. That's why we wait for the reversal to start. We don't try to catch the bottom because, like I said, no one can. It's almost like, you want to wait for if you want to get on a train and you're at a train station and you want to go west and you just go jump on a train, well, it might be going east. You got to wait to see which way that train starts moving before you get on. That's a good way to look at it. I wouldn't advise jumping on moving trains, but you get my point. All right, and then the last thing here is automatic data processing. Nah, I'm not really seeing that much, but once again, we can see our principles of levels that was support turns into resistance. If you know where these important price levels are, you're going to have a lot easier time trading. StockMarketJobber.com, I do a technical analysis lesson every day, well, 5 days a week. You can check that out on our website. Please sign up for our YouTube community here. And thanks a lot, everybody. Hopefully this helps you make some money.